First of all, sir, thank you so much for taking time out on a busy day at a super busy event like this. I think in many ways it's been great to see the journey that this event itself has had over the last 4 or 5 years. We've been fortunate to be a part of the journey from the first year of GFF, and I think with every passing year we only see the impact and scale at which it is operating only increasing, which sort of alludes to a broad observation that I think all of us have been in the fintech space for the last about a decade or so. That on one end we've had, I think, some pretty decent innovative work being done by fintechs across different sectors, from payments to lending to many other areas. But interestingly, over the last 12 months, right, there's also this feeling of now wanting to be a lot more vigilant, a lot more careful, cautious in their approach on whichever areas they operate in. And that's exactly where we thought it would be very helpful to get some advice and some feedback from you on the kind of regulatory environment that's sort of building up over the last specifically 12 to 18 months under the absolute watchful eyes of the RBI. What would sort of be the best way budding fintechs can sort of navigate, right, over time? So, of late, there's, I think, very regularly a common term that we are all hearing, which is responsible innovation. So one is, of course, the responsibility around the regulation, which, of course, it goes without saying that RBI has probably been amongst the most on the top regulators in the world in terms of the way they have managed crisis after crisis globally. But to come back to our sphere on the fintech side, responsible innovation could mean many sort of areas to keep in mind. Specifically, given the changes and challenges we have seen with new guidelines, new circulars coming out, maybe at a frequency of one or two every month. How should fintechs really look at navigating this space? What is it that they should keep at the heart of their business operating models, and what are the areas that they should be cautious about?
Right. Thanks, Vinod. It's always nice to be part of path-breaking initiatives, and just the energy in the GFF is possibly good enough to show what is there in store. Thanks for actually giving a lot of encomiums to the regulator. Ultimately, the job of a regulator is walking on thin ice. Go this side, you're going to fall. You go that side, you're going to be caught by the whales. But whatever it is, jokes apart, I think, yes, you made the right observation. Responsible innovation has been the approach. In fact, one of the things that has been at the cornerstone of what RBI has been doing, not now but for more than a decade, has been to actually provide facilitation to felt needs which customers have not got. And that is what is being actually backed by technology. The fintechs are actually able to do it. If you look at it, every innovation that has happened in the fintech space is actually based on a felt need which somebody has felt, somebody couldn't provide it, and therefore they could do it. So innovation is there everywhere, right from, I recall when UPI was to be implemented, we were all very skeptical as to whether this will work for the country, but where are we today? Perhaps we are the leaders in the world. So innovation is something which is fostered. RBI will always be behind it, but at the same time, the innovation should ensure that the 4 cardinal principles of responsibility for what somebody does, onus or accountability of what the outcome of what is happening. Third, to ensure that our foundation pillars of ensuring that the depositor's interest, the creditor's support, the common customer's entire confidence, and the last one is providing it all in a safe and secure environment. If these 4 cornerstones are taken care of, I think people need not worry about innovation. The other aspect, what you said is absolutely right. Quite a lot of instructions, regulations, circulars, whatever you name it, keeps coming in. Again, that actually, to my mind, is something which is positive, because it also shows, one, the industry is actually going fast and they are able to do it. Two, the regulator is also catching up, although it's behind, coming out with new guidelines, new requirements. Yes, it does mean that changes will have to be done. But at the end of the game, if we are able to do things in a manner which will go the way the regulator feels comfortable, and that the innovator is able to develop it and deploy it for implementation with the public, I think that's what is required. So if one were to put it in 2 sentences, what is it that's going to be the future? The future is going to be tighter from a regulatory side, but it's going to be looser from the type of the innovations, new ideas that are coming. That's one. The second bucket will be it's going to be more challenging to actually meet the regulatory aspirations, but that can be addressed by having a culture of regulation at the innovator side itself, which is what the self-regulatory approach is aiming to achieve. And the last point is do everything, but do everything with a little bit of caution. And if these three buckets are taken care of, I think the future is with the fintech which is actually doing it.
I'm glad you brought this point about culture, because I think a lot of us who spend time in the banking industry earlier, including Ambika, I think we can pretty clearly see the difference in terms of the organizational principles that we all had to abide by, which went beyond the regulatory guidelines as well in terms of adherence to whether it's compliance, KYC, onboarding and other areas. Given the gamut of activity and the number of players involved, this conversation about moving down the path of a self-regulatory organization, and I think RBI has been doing far more deeper thinking, I think, beyond what the industry could. So thinking about SROs as different SROs for different verticals, right? Do you believe that's sort of a better long-term answer with more self-governed or self-regulated play coming in before the RBI has to start looking at some of the broader parameters the industry operates on?
Actually, I will have a slightly different approach to this in the sense that the regulator is looking at certain things. The regulator has an SRO approach. There's nothing two views about that. It will go that way. But my view would be that at the innovator side, at the implementation side, at the entities which are part of it, the number is going to be higher. If we can impregnate some amount of culture of regulation, use the right word, the culture, where we do things in a manner which will, in our opinion, let's try to empathize and see what, if we were the regulator, what would we do? And most often than not, whatever we think and the regulator think will be on the same side, except that sometimes the business and the regulatory aspects may not exactly match. So if that is something which we have at the bottom of our initiatives, our implementations, our entire business approaches, I think we can do it. In fact, if you look at most of the successful implementations or successful fintech innovations which are taking place now, most of them have that thread in common, that they have taken into account what perhaps would be a regulatory challenge there, or what will be the regulatory upset which they are trying to take care. And if that is taken care of, all of them have had success paths. So I wouldn't say it's a great change that is required. Just do something which put yourself in the regulation, and if you do it, that's true. And if that comes and if the regulator gets confidence, here is an entity which does what we want them to do, after that the path will be fairly easy. It won't be a glide path, but at least it will be a parachute path where you need to go in a smoother way. That's what I would say.
I just want to bring in Ambika also on this point, important point you mentioned, sir, about directionally it only getting a little tighter. Correct. To ensure there's a lot more discipline and cautious approach as far as the end consumer or the end customer's interests go. So Ambika, from let's say banker or ex-banker's perspective, right? We've seen a number of regulations and lived by them or worked on some of them as an industry participant earlier, versus sort of coming into this blended role of what I call as responsible innovation. If this tightening sort of further continues, do you somewhere see innovation actually becoming a little tougher, or the principal reason for fintechs to be around, which is to help increase and expand the market, that getting that much degree a little tougher?
I would strongly believe that any innovation has to be responsible innovation, and hence it has to be built, as Mr. Ganesh Kumar mentioned, on sound principles of accountability and following the regulation. Because the regulations which are coming across from RBI is also towards the larger good of the economy and the country per se, primarily because they are seeing from their bird's view point. There has been various kind of players in the market which, even if one or two were to misbehave, could cause a lot of pain and agony. So coming from that, having been a banker myself for the last 40, 30, 35 years, I do respect that the regulations are definitely required, but probably if it starts pinching, then it would be an issue from a overall growth and economy perspective, because as you rightly say, the shoe size has to be the right size. If it pinches, it hurts. If it's loose, you triple. So having said that, RBI being in its coveted position of being a regulator, they would have to have the balancing act, because if you were to look at the country's growth plans for 2047, we want to be a developed nation, and we all know how MSMEs play a vital role in the growth sphere for the country. Like if recent deputy governor's report was all indicative of the same, saying that MSMEs provide 40% of the manufactured product, they account for 1/3 of the GDP, they account for 40% of the exports. So while the regulations are definitely have to be a kind of a fence towards good behavior and responsible behavior, but it should not kind of strangulate the growth of business. That is where we need to be very little watchful and have the balancing act. And I'm sure at the high level quarters they would be viewing every aspect of the steps that are being taken and what is the impact which is happening in the banking or the financial sector as such. Um, given that kind of a scenario, I have a question for you, sir. That while we all know the kind of the way the retail loans are growing in a very unbridled manner in the country via the NBFCs or the Fintechs, which has been a concern. But given that MSMEs have to grow in a healthy way, and you want the interest rates or the credit proliferation to them at a reasonable cost, that is one area of where Reserve Bank would definitely want the lowest rung of the MSME clients getting quick credit, needful credit, and also the appropriate doses at the right cost. That is one scenario. But in the other scenario, having the risk weights for NBFCs increased over a period of time, which translates into higher cost for these NBFCs or the Fintechs. How do we address this? Because at the end of the day, there has to be a clear demarcation of those NBFCs who are only for MSMEs and the ones who are for the general real retail loans. There should be a differentiation while assessing them, and for their debt requirement or funds which are there to be transmitted to the MSMEs. What's your view, sir, there?
Right, Ambika. Actually, very valid point. I'll make a couple of points and then I'll give you my views on that. First one is, it's not that this risk weight differentiation or whatever is there for the retail is only for the NBFCs. It's the RBI has been voicing the same concerns for the banks as well. And as you're aware, many of the banks have also moved away from the earlier style of what used to be called lazy banking, only corporate exposures, to a lot of retail. Having said that, my observation is the entire world is undergoing a change. There is a significant amount of movement towards the retail sector, the retail credit going in large leaps and bounds. But then again, that's an area where it's not been fully tested in the past, where the level of delinquency is something which gives comfort. So to my mind, I think this is something which wherever RBI goes in, it treads with a little bit of caution. As you're aware, since you've been a banker, the depositor's interest was of paramount importance for the last, let's say, half a century. The change in the RBI's thinking right now is that creditors, meaning it's not the person who takes the loan, but the institutions which give the credit also need to be protected, and that they should not be exposed. And that's why the focus now is the same type of importance, same type of aspirational aspect which is coming on the deposit side should also come on the
lending side.
And going to the retail, since it is an unknown, there's a little bit of tightening now. So your point is very valid. It will have an impact on costs, it will have an impact on prices, it will have an impact on the way delivery happens to the targeted MSME or the other sectors. So my view is that the RBI will be watching what's happening. I find that there are green shoots which are happening in the entities, whether it's the NBFC or the banks, that the level of delinquency or the level of default in the retail is not one which is of concern as things stand. And if that trend continues, I think RBI will be liberal in that area. But it also depends on all of us who are part of this to ensure that that trend improves and not deteriorates. If that happens, I think it should happen. Yes, in this interim period, it's a bit of a challenge.
Yeah.
But then, as always, innovators also are people who are challengers. They have to run the road in a very difficult way before the followers come. Part of the game. But I think the long run, this will certainly be something which the regulator will
It
embrace.
will get addressed, yes.
So, we spoke about two things. One, in terms of regulatory expectations from all players, including Fintechs, possibly becoming tighter.
Yeah.
And the fact that regulators also have had a very active time looking at so many different areas within the Fintech and banking ecosystem, and then having to then issue new guidelines such as the other way to regulate, which has probably been the historic past, which is really to look at all the set of regulated entities, whether it's banks, NBFCs, or related players, maybe even capital markets, and regulating through them, right? Now, it is a fact that in a market like India, for most Fintechs, having a regulated entity partner, whether it's a bank or an NBFC, is extremely important for them to be able to deliver most of their services, whether it's lending, whether it's payments. Eventually, the accounts have to sort of be residing within the regulated entity.
Correct.
Do you see, RBI's path also including indirect, control or influence over the fintech evolution through the regulated entities by providing them more either clarity or tightening, and that then percolating down to maybe a little more clearer but possibly tighter, guidelines which manage those partnerships?
Right. I might take a minute extra on this so that I'll go into the genesis. If you look at it, at the base is the RBI's concern about ensuring that the systems are safe, secure, and that the target audience which is using the services have total confidence in that. The first level of usage of this, or the customer touch point, used to be the banks, and therefore the RBI's regulation was on banks. That changed over time, and then it came to the next layer where it could be NBFCs, it could be other service providers, etc. When one goes into the payment space, I'm just using that because that's an area where there's been a lot of fintech involvement. The next level came in where the service providers started providing the service, and as long as there was no systemic risk in the service providers providing, the RBI was keeping aloof. If you take the case of cards and credit cards, the first credit card was introduced in India, if I recall right, in 1987. But the regulations relating to credit cards came in 1996, which was almost clear 9 years. And that came in only when mis-selling and all other things happened, where customers were getting affected, and that's why they came. On a similar note, if you look at it, payment aggregators, who are a very important part of the entire payment chain, were not on the regulatory space till around 3.5–4 years ago. So on a similar basis, Fintechs also, I don't think it's the RBI's intention to bring the Fintechs or the service providers or purely I would say technology companies, whether they are Fintech or health tech or whatever tech they are, under the RBI's ambit of regulations. It's not their intention. But when they do something which transcends the border into something which impacts a user of a regulated service, which could be, as you rightly indicated, it could be banking, it could be credit, it could be payments, it could be anything which the regulator does, then one could expect two approaches. First, there will be a light touch regulation where the entity will not be directly given directions to do. It will be the main person who, or the company or the entity which is retaining the services of this fintech, will be the one which will be under the entire radar. The next level will be, if that doesn't work or if the systemic risk increases, which is when the RBI will come out with guidelines. To my mind, I think the RBI coming out with guidelines or diktats saying thou shalt do this or thou shalt that will come only when that particular subsector becomes very significantly important. I don't envisage pure tech companies reaching that stage, at least in the near future. But those who actually are tech companies but also do some related function where money is involved, I'll put that as an easy thing, whether it is movement of money, whether it is storage of money or whatever, and that's where we all fit in, then my view would be, because ultimately that is something which impacts the economy. I'm looking at it a bigger perspective of what the RBI is looking at. You can expect initially light touch regulation, and if that works, very good. If it doesn't work, then there will be full-fledged regulation. I would put a range of a medium term, which is 3 to 5 years for this to happen. So no immediate worries, but at the same time, if things are done by all players in a right way, that can get postponed. If it doesn't happen, then that can get hastened as well. That's how it will be.
One last question from my side, maybe over to week after that, the RBI governor announced ULI. So UPI, as we all know, has been not only a massive success as far as Indian payment digitization has gone, but also it's now probably one of our soft exports, if I can call it that way, to many deserving countries overseas. Do you see, though it's very primitive because we are all awaiting details about the model, but do you see ULI sort of equally revolutionizing the whole lending ecosystem over time? And in that sense, UPI enabled a lot of consumer benefits, keeping fintechs actively involved in the whole journey. With ULI, do you see fintech innovation and their role continuing further on the lending side as well?
Right, actually very valid observation. One needs to actually go a little bit back in time. When UPI was actually introduced by the RBI, of course there were a lot of fintech supporters who actually ensured that the entire thing went through very smoothly. There was no similar facility available in the payment space, and that's how it started, took off very well. To my mind, in the ULI space, the challenge is not that there are not it's not the absence of players of that. In fact, there are multiple players, and I think the underlying theme in your question is that what happens to the existing players? What are they going to do? Is it going to be a competitive disadvantage? My view on that is because some of these players have actually shown the dark side of that, and most of them are not Indian players. You are aware of what is happening. So at the end of it, if it's a customer who is getting confused, if the customer is going to be taken for a ride, one of the approaches seems to be, okay, in a manner similar to UPI, let's have ULI. That's what is the approach. I wish I was an astrologer and I could do some soothsaying, but no, jokes apart, I think what is going to happen is that today the name of the game, and that's not only in fintech, across the technology world, including in healthcare, including in any other things, there's a move towards distributed services availability, but consolidation at some point. Whether you look at airport services, whether you look at hospitality services, medical, this is what's happening. So to my mind, credit availability also will, each pocket, each differentiated service will continue as it is, but perhaps ULI may be a linking factor. So the way I look at it is, if I, as an ordinary citizen of the country, want money, I just need to go to ULI. That becomes the one point of entry for me. Once I go through that and pass whatever is the minimum requirement, one has to wait and see how the metamorphosis will happen. Thereafter, depending on my requirement, whether I'm an MSME, I'm an individual customer, whether I'm a corporate, etc., there will be rails which will actually sift it down to where the particular expertise in that credit delivery mechanism is there. And just to use the Vayana name, if it is related to trade finance and that's what is going to be there, it's like in the olden days when you used to have a goods shunting yard, the goods train will come, wagons will go to various loop lines depending on where the final destination is. Similarly, ULI may be a gateway. It will then hand over the control back to the players who are there now. So to my mind, I think it will be some change, but I don't think it will be a completely disruptive change. In fact, it will, if I look at it that way, as a company, if I were Vayana or if I were any other company, I will say I get the advantage of saying I'm passing through RBI's gateway, which gives me a lot of marketing advantage because the customer thinks it is RBI available. At the end of it, I retain my uniqueness as Vayana, and that will also go ahead. So I think there will be some challenges, there will be some re-engineering we have to do, but at the end of it, I think it will be beneficial for everybody. That's why I look at it.
Thank you so much, sir.
Just one kind of suggestion or an advice from you. One of the things that we have noticed in credit dissemination to the small MSMEs or SMEs is every player or every lender is collecting various kind of financial documents from them. While we have repositories on a consent base from the bureau or from the GST requirements, because today lending has acquired the form of various means of getting the information. So is there any thought to have a centralized repository where not the listed is never a problem, the listed companies are never a problem, the unlisted companies, financials where it could be stored and any lender could acquire or dip into it for the information on a consent basis. Is there any thoughts around that?
Yeah, actually there are two things which is there. You did talk about the listed companies and those who actually provide data on a regular basis. It's already taken care of. The other entities, the very fact that they are not listed or not under any regulatory purview, it could be under Ministry of Corporate Affairs or it is under SEBI or RBI, whoever it is. Point is there is a challenge there, and that is why you will be aware of this NFIR which is coming, the National Financial Information Registry, which is an initiative of the RBI but not purely done by RBI. The industry is also joining hands and doing it. Something similar to the UPI model there. So my view is that once the NFIR comes in, there's quite a lot of paths to be covered in this. My gut feeling is it could be an unlisted entity. The unlisted entity may not be giving any data, but the unlisted entity will certainly have transactions done through some entity which is regulated. It could be a bank, it could be an NBFC, it could be somebody else who is doing it, and this entity will actually provide the information. So my gut feeling is either NFIR or an offshoot of NFIR later on when it comes will be where you will have a huge data bank of information available, which can be dipped into on a consent basis. Consent means I'm not talking of the consent of the unlisted entity, it's a consent of the entity which is taking the data to say I will use it for this purpose and not for any other purpose. I think it's going to work. A lot of this hinges upon the regulations which are going to come very soon on the DPDP Act, the Data Protection Data Privacy Act. Indications are that they are going to give broad guidelines and specific instructions will come from the respective sectoral regulator. So my gut feeling is a marriage of that with this central registry will actually address the concern that you have, and people should be able to take care of.
Since you did mention about the NFIR, while it's a great move to have, but if it is going to source the data from the banks or other providers of service to the unlisted company, it's again going to be only transaction based data. What we are looking at is there should be a repository where the unlisted companies financials in terms of balance sheet or P&L should be in a available manner, so that each lender need not go and source the same information.
Exactly. In fact, what will happen is, and I don't want to give an euphoria as if every problem is going to be resolved. It's not going to happen. See, the way the RBI or the initiatives in the Fintechs, in the financial sector will happen is that they will only take the data which is under their ambit. Now, if it is going to be balance sheet data of an unlisted company which is not in the space which is under their regulatory purview, I doubt whether they will do it, and if they do it, it will be challenged in a court of law, and I think they will have to eat the humble pie. So, to take care of that, my gut feeling what will happen is with later technologies coming in using AI, etc., it will just be a consolidation. Pick up this data from the NFIR, pick up some other data from the MCA database, take some other data which is possibly available in the public domain, and in fact, taking the point of Vinod earlier, there could be some FinTech innovators who will try to actually consolidate all this, and it will be available as a like we have software as a service, or today even crime as a service. You will have data as a service, and then that is what I think is going to happen in the future. It's a little forward looking. It might not happen tomorrow, but I think in the long run this is how it is.
Yeah, it could be a welcome move for the lenders for sure.
Correct.
That's I think a cue for both of us to work on. Basically.
Yeah.
You have a huge potential and you have an opportunity.
Especially the B2B segment. So thank you so much, sir, for giving us your valuable time and guidance as always.
Thank you. It was a pleasure.
Collaborative future,
Sure.
as you said. Thank you so much.
Thank you so much.
Thank you, Vinod. Thank you,
Thank you.
Ambika. All the best.